Welcome to Multifamily Grit, where we bring in the experts to share their stories of the celebrations and struggles of one of the most important industries in the U.S., multifamily property management. I'm joined today by Marc Hershberg, co-founder and managing partner at Topaz Capital Group, a private investment firm specializing in multifamily real estate. Marc began his career at UBS Financial Services, supporting portfolios worth over $1 billion across global capital markets. Before founding Topaz, he focused on structured finance and private debt at Brick Capital Group in New York. And at Topaz, Marc leads investment strategy, acquisitions, and investor relations, bringing a sharp eye for value and innovation. He's also a respected voice in the industry, contributing to outlets like Forbes, Globe Street, and Commercial Observer, and serves as a guest lecturer at NYU. Today, we'll talk about Marc's journey, his unique approach to underwriting markets, not just deals, his thoughts on the current economic climate, and how he's navigating today's investment landscape with the big A word, accountability. And before we get started, we are sponsored today by the only core property management operating system built with an emphasis for affordable owners and operators. Fortress revolutionizes affordable management with features focused on automating housing assistance charges and payments to keep your ledgers clean and accurate, centralizing file reviews and document storage through Fortress leveraging AWS, and a free in-system smart waitlist to ensure your property stays in compliance. And don't forget, if you like what you hear today, please like, subscribe, and share with someone you think would enjoy this episode. So, Marc, thank you so much again for being here today.
Thank you, Kerri. Really appreciate the opportunity, and obviously not only to chat with you, but also be on your platform.
Yeah, thanks. Before we dig into that chat, which I'm pretty excited about today, would you mind sharing with our listeners how you got your start in the industry?
Absolutely. So, from my perspective, obviously, it was kind of a natural progression. At least that's the way it felt. The industry, my interest in the industry was really from a banking perspective. So kind of went the corporate banking route at UBS, got a chance to see the different departments within the bank. What always excited me was tangibility factor, right? So kind of like the sense of, hey, the markets are interesting, valuations are interesting, but it seems like a ticker and behavior happening, but there's nothing really to look at, or as we call it, Topaz, kick the bricks. There's nothing really to touch and feel behind the asset or the equity that you're investing, equity or debt you're investing, right? So that's really how that's how I personally got interested within the real estate sector. There was a tremendous affinity towards building potentially generational wealth. For me, and that's something that myself and my partner are looking to do. Of course, we want to solve for our own financial needs, but ultimately we do feel that we're well positioned as a company to continue scaling and looking at this as a multi-generational business. If done right, executed properly, of course. And with that, we were very fortunate, both of us, to have myself and my partner, shout out to Eitan Friedman, who really, we had great mentors, and they said to us, guys, you could do this yourself, and this is not rocket science, what we're in, and we're here to help you along the way. So, very grateful to Treetop Developments founders, Ozzy and Adam, and Brick Capital's, founders and partners, Eric, Joel, and George, specifically Joel, who's taking me under his wing. And actually, hopefully today, we have a closing on one of our quote-unquote legacy assets that I bought while working for Joel, which evolved into the creation of Topaz, the taste of ownership and lick of ownership that was became so great that Topaz was launched actually out of their office with myself and Eitan. So that's kind of how this all evolved. And I don't think it's a surprise that living in the New York City, Bergen County, New Jersey area, and being back between those two communities, there are a lot of real estate investors, owner-operators. So it wasn't a foreign industry to us at a very age.
Yeah, it's such a great story. And congratulations on the closing that's happening today. That's very exciting. How long have you held that asset?
So that was the first one I ever bought, late 2017.
Okay.
November 2017. And Center City, Philadelphia, prime on prime, Lombard, right next to Liberty Bell. So great asset, just one that since 2019, and I'm sure you've been hearing this a lot, assets in these markets, in markets like Philly, New York, Chicago, and LA, it's challenging when you have multifamily apartments. And so we have found it more creative to redeploy our equity elsewhere.
Yeah. Okay. Great. Well, congrats. It's not easy to get deals over the finish line right now. So, which we'll talk about a little bit more from your perspective on the acquisition side as well. Like I said, anytime anyone tells me that they're closing on an asset right now, I feel like it probably took a lot of work to get there versus, a decade ago was a very different story. So, tell me a little bit more about Topaz. Obviously, you speak about it like I do Fortress. I joke that Fortress is my second child of three because it came to life in between my two children. And so obviously I feel like you're just as you speak just as affectionately about Topaz. So tell me a little bit more about Topaz and what you guys are doing.
Sure. And actually, to use your analogy, I would say this is my first child because I co-founded Topaz with my partner prior to having both our kids now, which is very blessed to have. First, so I would call it our first baby.
Yeah.
And I was, just at the time also getting engaged. So definitely, well, actually, for not for this podcast, unless you want to include it, but one of our first closings together outside of, when we finally banded together, my partner and I, one of those closings was happening the day after our wedding, the honeymoon suite of the hotel. I kid you not. So, so there are definitely a lot of stories between marriage and babies that are involved with our company. So,
hey, I get it. Yep.
Yes. Definitely parlays itself to the real world.
Yes. Yeah, I love it. No, I mean, for entrepreneurs, for founders of companies, like, I feel like there's this pressure in society that like we shouldn't care as much about our, jobs as we do our families. But I mean, at the end of the day, like Fortress is a huge part of my life. I mean, and even if you take a step back from the fact that it's obviously a part of my life that funds the rest of my life, but I also consider all of the team members that are a part of my team, partially humans that I'm responsible for. Like I am responsible for ensuring Fortress is successful in order to ensure that they bring a paycheck home for their families every day. So like Fortress is, incredibly important to me. And so I'm not ashamed to call it my second child. I'm really not.
No, it's incredible. And obviously, there's a lot of importance to that. And the passion is what we've been finding, and I'm happy to get into that later, but passion is something you can't buy.
Yeah.
And part of our hiring process now is, one of our main questions when we get off the call internally is, what do you think their passion level is?
Yeah.
And of course, to go with your podcast, we could say grit. But really it's looking at that passion, that grit, that tenacity, and that burning desire to want to accomplish and solve problems together as a team. So yes, that's something that's very real for us, and we're actually having those conversations in real time today and prior to this call.
Yeah. So no, I think we can talk about it right now. So hiring, is Topaz hiring right now?
Topaz is hiring right now.
Yeah.
We are hiring, predominantly looking for a rock star acquisitions member to join the team, and also a TBD on whether it's this quarter or this upcoming quarter going to 26, but potentially another person, a controller or someone on the accounting side to kind of dive further into our trajectory and provide more value add as we scale.
Yeah, absolutely. Well, whenever anyone asks me like, how are things going at Fortress? I say, well, we're hiring. So like, I feel like in this industry, in this economy, if you're hiring, it's a sign of good things. And then you mentioned, how important passion is to you. So, when you guys are looking at bringing on new team members, and I feel like this is like culture is important, clearly very important to you. So when you are looking at bringing on new team members, what specifically are you looking for?
a great question. Typically, there's always an element of chemistry, which is hard to quantify.
Yeah.
So chemistry, I would say, is a big one.
Yeah.
Um, I would say flexibility and agility is number two. If we had to put it up on the kind of the top of the list.
Yeah. I mean, for a small business, like that's so important.
Incredibly important, and then I think tied to that is self-start. Being a self-starter, being someone that's not waiting for directives. They're proactive versus reactive.
Yeah.
The proactivity is key. I mean, we've been seeing it more and more, and we're just so pleased when we see it, and we say, hey, so and so, this is awesome that you took this extra effort to make this happen, or you're thinking about something happening in the near future and how we can make sure we're set up for success there, right? Versus stealing and putting out fire, the fires of today, or solving problems.
Yeah, we use a phrase a lot at Fortress: ask forgiveness, not permission. We don't want people like sitting around waiting for answers. We just want people to just go get shit done. And you know what? If you screw it up, like, who gives a fuck? Like, I mean, we feel like if you're not making mistakes, you're not trying hard enough, right? So, we think in the same vein.
Yeah, and mitigate those mistakes as best as you can if when they do happen. And if there's a way to, if it's a quick text message to the group or to the team saying, hey, I think I might be onto something, or hey, I think I might have messed up, then let's just get ahead of it. But one thing that we'll say that we've been saying a lot recently, also on the hiring front, is it's critical, and I hate the cliche, but it's so true. It's just be quick. Slow to hire and quick to fire.
Yeah.
I mean, that's really, the name of the game. And if you can't do that, it ends up coming at the cost of your entire business. It really does. Especially as a smaller company. It could cost of the large part of your business.
Yeah, gosh, that's so true. I talked to of my team about this a lot, especially people who are new in leadership roles, and they feel this like responsibility for anyone that they've ever hired, and so they have a really hard time letting people go, and they just keep thinking, like, I owe it to this person to keep trying. And I'm like, gosh, if I've learned anything over the past 10 years, my past like 10, 15 years in leadership, I can say that there's three things that I always think about in order to facilitate firing really quickly. Like, first and foremost, that my obligation, your obligation, is never to the person being fired. It's to the team. Like, that's it. Like, if the person is, at the end of the day, if you're feeling this like being compelled to like take care of someone, it's not that person, it's your team. Like, your team is the one that you owe everything to. You don't owe anything to any individual human. It is to the team and to that team's ability to be successful. And then the second thing is, I love to use the bad apple analogy, but they've done all sorts of studies all over the world, psychology studies around, you take like this group of high performers, whether there's 5 of them or 20 of them, you take a group of high performers. And if you insert one bad apple into that bad apple drags the performance of that entire team down. It is extremely, extremely rare for the group to bring the bad apple up, and it requires like a very specific personality type. It's really rare. So I'm like, keep those two things in mind all the time. But then the third one, and I think the one that always hits home the most, is like, for every one thing that you're aware of that person is doing wrong, they're doing like 4 or 5 more. Like, you're just aware of one. And then for every one, there's like 4 or 5 more. So if you're aware of 3, like, just let them go. Move them along, right?
Yeah. Usually when you see something, there's a pattern behind it, right?
Yes.
I think that's kind of what you're getting at, is like, not everything is isolated in a solo scenario. In fact, more times than not, you're absolutely right. We find that there are a lot of other things going wrong, or very right if it's going right.
Yeah, so. Exactly. I'm always entertained when we let someone go and we then have to have like the exposure to what was really happening, and you're just like, oh my gosh, like, I had no idea it was so bad. So
and then to your point, also, like, the sooner you realize that, the better it is, because if that stuff is lingering and it's been festering, and then it's harder for the team to step in and right those wrongs, or at least to make up for some of those lost time or mistakes that happen.
Yeah, absolutely. Well, it seems like you and I have very similar philosophies on team management. But outside of that, what is Topaz like specifically focused on right now? Like, what's your mission as a company? What are you guys trying to accomplish?
Absolutely. So where we are today is we've kind of considered and been classified by most in the industry as a Florida multifamily sharpshooter.
Okay.
Say multifamily, I'm usually referring to community style living, so garden style, low to mid-rise product up to 5 stories. We've kind of pivoted to newer vintage product. Historically, we were like most folks, your heavy value add 70s product.
Yeah.
70s vintage product, getting in as high as $35,000 to $40,000 a unit in capex. So really like basically a construction site. And getting out of those deals. And we feel pretty adamantly and fervently about the fact that the industry has taken a different direction. That those heavy value adds in and out scenarios are not risk adjusted any longer.
Yeah.
And B, you're too much banking on market cycles and the fact that you could time them. And if I've learned anything, it's that you cannot time market cycles.
Okay.
And you cannot, time, really anything outside of your control, any external factors, cap markets, pricing on construction. If anything was to teach us that, I think it's COVID, right?
Yeah.
COVID hit us, and all of a sudden I realized that what we've underwrote as our deal, and this is the case for most of our competitors and most of them, if not the entire industry, is that what our capex, let's say we had $1 million of capex allocated for the project, that $1 million turned into less than $500,000 overnight. And that's not because we did a bad job underwriting for it or we had the wrong talent. It's that the talent cost, the payroll got higher. So the job work, the site work, the human capital is more expensive.
Yep.
The labor, and then on the other flip side of labor, also what got exorbitantly more expensive is the materials.
Yeah.
And in some cases you can get the materials. Some cases you couldn't even get the materials. Rather.
Yeah.
So sure, you paid a premium to get the materials, which actually was in many cases a greid scenario. Some of us were like high-fiving each other, like, hey, that's awesome, you got it. And you were only paid 20-30% more. And I was like, well, I wonder why you're saying that. And they're like, well, we couldn't even get this for last year.
Yeah.
And especially with appliances, a lot of things that were related to international, chips and parts that, required international trade and things of that nature. So it was mostly, I would say, appliances that we experienced that with. Of course, if there was larger renovations, we also experienced it with electrical replacements, panel replacements, and some plumbing as well.
Yeah.
But that's really where we saw a lot of that challenge.
Yeah. And so you went, and I agree, so many groups were focused on that value add, and now they're starting to, so many groups over the past few years have started to back away from that. Like you brought up, like the risk is not panning out to the reward. So now you're focused on some of the newer product right now. And is there a certain size deal that you look at specifically?
Yeah, so it's a great question, and I'll tell you kind of how we got there. So we went to newer product for us. At one point, we were saying 1980s or newer. We kind of gave a premium to 1990 or newer product. So right now, we're mostly focused on 1990 or newer. Yes, we look at great deals that were well managed and operated during the life hold since it was built in 85, because you can argue that a well-built, well-managed and operated property since 85 could be better than a 90, 91, 92 vintage deal, right? Property. So, we really look at, how it's been managed since it was built. And what we try to do is we try to make sure that there's minimal deferred maintenance. And if there is deferred maintenance, has it truly been cured? Has it truly been cured ultimately and repaired. So that's something we're finding that most of the market does not do. You have a few owner operators that actually do go above and beyond to repair those deferred maintenances. Usually you're finding to be more institutional, kind of REIT level, owner operators, less so, or very large private multi-generational families. Outside of that, you're really not finding most folks carrying to that level and investing in the property to that level. So we're very cognizant of that. B, we will look at deals as low as 80 units now, 75 to 80 units. And why that is because we want to bet it. We want to take advantage of the fact and leverage the fact that we are a local sharpshooter. So the fact that, we are currently and continuing to grow our footprint predominantly between Central and Northern Florida, excluding the Panhandle for obvious reasons of insurance and, market growth hindrances due to, a lot of disasters that occur there on a recurring basis, hindering the growth of the markets. But, ultimately within Central Northern Florida, our perspective is, okay, well, let's make sure that, we are looking at deals that are a little bit smaller, but that can be potentially grouped together with a larger property and asset. So that's where we kind of pivoted. So we pivoted to newer vintage product, typically more turnkey, mostly interiors, maybe light exterior value adds and CapEx scenarios, all the way to forward-looking contracts. Like right now, we're negotiating forward-looking contracts with home builders on BTR product and multifamily product. So we are doing that. We're getting creative and offering mezz, pref, bridge to those to our sellers or potential partners. Some cases we're dealing with a lot of recaps also. Groups that are saying, hey, well, it's not an accretive. We still see the value in the asset and or assets in plural, and we don't want to just let it go today. We think there's another bite at this apple that's very juicy, and we want to be a part of it. And so we'll go ahead and recap out whatever equity they have. Sometimes we recap out their equity investor plus a couple dollars of their own so they could go reallocate it elsewhere. In some cases, they invite us into the next deal. In some cases, they say, hey, well, no, this is already, we're just trying to fill what's, a backstop or some sort of commitment we made on another transaction. So that's something we've been doing more often. It's been great. It's been a lot of upfront work, candidly, and building direct relationships with all these developers, both local, regional. Predominantly, we're hyper focused on the local guys because we are local guys. A and B, the local guys tend to have a better pulse on the dynamics going on. And then C, we find that the local guys typically don't have the very large institutional capital relationships. So that's where we kind of shine and say, well, yes, we're a lean, fairly lean and mean shop. We're smaller and boutique kind of private equity real estate shop. But what we do have is we have the same capacities as the larger institutional firms in the sense that we have large discretionary capital sources and, direct relationships and partnerships with the leading lenders and things of that nature. So we're able to add a lot more value to your local and regional owner and developer versus your, large institutional owner developer. However, in a recent circumstance, what we're finding is that the large owner developers need co-GP partners in the GP stack. Even though they still have their institutional investors writing them checks, they are finding that they have to write bigger GP checks, right? So we are also helping them and co-investing 50-50 alongside, or as long as we're 50-50, usually 51+% of interest and of equity interest and controlling interest and decision-making interest. We'll also participate on the GP side, not just, the entire of the deal. And of course, that's sponsorship driven. So this one group is one of the best names in the business. He asked us if we'd want to do it, and we said, you know what, yes. In this circumstance, it could make a lot of sense. So that's something we're also doing that's kind of unique. And we're also finding ourselves, having to get creative. Back to earlier, not only are we pivoting on vintage and deal size, but we are also saying to ourselves, well, hey, let's also be a little more agile on markets. Let's look at markets that are high growth, but maybe they're not 500,000 plus population. Maybe they're 50,000 population, but they're a good feeder. They're good growth metrics. And, the cash flow is good enough that we don't need to look at a near-term exit anyway. So we are getting a lot more, open-minded and flexible in terms of kind of what we're looking at. And we're grateful that we have just such good partners and servicers that are willing to, kind of, be sharing that open-mindedness and opportunistic, abilities.
Yeah, I love it. I think it's such a smart approach. I mean, it's, probably one of the biggest downfalls of entrepreneurs or startup companies is this like the phrase where we try to boil the ocean rather than like focusing on something really specific that we're really good at, and we know that that's our niche and that's where we are better than others and more creative and more responsive and more capable. And I think if you can hone that in and find that, there's also another phrase, the riches are in the niches, right? So you find
Right.
that niche that you're really good at. Don't boil the damn ocean. Just like find that space and like hone in on that, especially early on. Like early on, that's where you're really going to find your success. And then obviously, the bigger you grow, the more you can expand that niche and start to focus on other opportunities. But I think it's a really smart strategy.
Yeah, and I think part of that is like and which we'll get into in a little bit, I'm sure. But our prop tech investing or any other investing
Yeah.
outside of our core business is all complementary to our core business. So it's all complementary to our core niche business, to be precise.
Yeah.
And so that's something that we really take a strong interest in is, okay, what can we do to be better at asset managing these properties, financing them, and ultimately investment managing them for investors. And that's where, the likes of Juniper Square,
Mm-hmm.
we lean heavily on them as a partner, and other groups as well, where we lean heavily on them, whether it's, investment management, operations, asset management. Now BI is a big conversation, business intelligence, right?
Yeah.
So we onboarded a new technology. We're partnering with them called Symmetry, Symmetry, great company run by Ross and Jack. And they're basically doing asset management and BI in one. So they have asset management and business intelligence tools all in one data, integrated platform. So we're able to now leverage that and use AI and use really sophisticated software to really look at outliers, really look at where things could potentially be festering and problems that could be a little more proactive and kind of identifying problems that could be arising in the near future. So that's something we're doing. We're rolling out as we speak. We literally had the call yesterday. So that's exciting. And then, of course, we have other partnerships with other, prop tech companies that, we think could really advance, us and kind of differentiate us from the pack.
Yeah, that's incredible. And investing in them as well. So are you investing in, I'm assuming you're investing in the prop tech you're choosing to use, right?
Correct.
Yeah.
So if we can't use it, we won't invest in it.
Okay.
So our whole approach is we are true strategics, and
Yeah.
that's kind of our spiel is that we are your true strategics. We are your folks that are looking for, looking to give good feedback, because that feedback's not only going to help our investment, but that feedback's going to help our company.
Mm-hmm.
And that's where we're finding a lot of folks coming back to us, and we're very grateful that we've been getting calls from some of the best VCs in the business, say, hey, could you come in as strategic, or some of the best founders that are saying, hey, could you come on board? It doesn't always have to be an advisory capacity. In fact, we don't love the advisory capacity because it comes with a lot of strings attached, and it pulls away from our time from the business. But what we always say is, you have a question for us or you need a few minutes, just reach out and we're available. So that's something that's been really amazing. Rolled it out the last few years, and we've been bearing the fruits of that. And hopefully that just continues.
Oh, that's fantastic. So going back to, and I think that's obviously as a founder of a prop tech company, I think that's fantastic. Like I love, we have a couple of Fortress customers who've invested in us as well. Actually after using the product, not before, but and it's incredibly meaningful to have that relationship also be a partnership. So I think it's so smart, and it works so well for you too, because like you said, you get to have an impact on like where the product goes, and hopefully help build that secret sauce, not just for that product that you've invested in, but also for your assets. So yeah.
Right, exactly. And also, of course, if you have an issue or whatever, and you're constantly in contact and you're constantly helping the other, they're going to want to help you too, right?
Yeah.
So it's that relationship. And of course, for us, with another benefit, and And then I ask, because I'm only I'm a glorified fiduciary. I'm just someone that, I'm a glorified asset manager, wealth manager, investment manager, whatever you want to call it. And so, for me, it's like I'm also able to ask for favored nations pricing on the software,
Yeah.
and sometimes it's, hey, use it, trial it for a while. You don't have to pay us, or hey, pay us, but we need to be paid because we're about to get another round, and
Yeah.
or this round we need to be paid, but you're
Yeah.
getting those favored nations economics on pricing. So
Yeah.
that's really another huge benefit, tremendous benefit to why we do what we do on what we call Topaz Ventures, which is our proptech arm.
Yeah, that's great. So going back to your the investment side of the house, the asset investment side, you've mentioned to me that and we've talked a little bit about like how hard deals are to source right now, but that you have a little bit of a unique approach, and I think it comes from your history in the industry. What's your secret sauce to underwriting deals?
So it's underwriting deals and to sourcing, or mostly underwriting, because it's a very loaded question. I can
Yeah,
go.
yeah. No. Mostly I think, you mentioned to me that you underwrite markets, not deals, right? So tell me a little bit about that methodology.
Absolutely, absolutely. So one thing and this is not my credit, goes credit to Joel Radman, my former boss, and now partner in a few deals. So Joel always said to me that, deals can't drive markets. So don't ever try to, and as an econ geek, candidly, I always had that approach, is that look at economics of the market before you look at the deal itself. So it's in my nature, it's in my blood, and I was taught, I was taught under the leadership of Joel and Brick to do that. And so the reason for it is predominantly that if a market doesn't do well, but the deal does well, your benefit of valuation and upside is, is capped.
Yeah.
The market. However, if the market grows and you don't execute so well, on your side, you can still have the same value appreciation of your asset
Mm-hmm.
due to the market's growth, and you didn't even execute well. For example, in 2020 and 2021, people were doing horribly on operations, like absolutely horrid operations. Like, it is scary how they were even in business. Basically no oversight, basically no management. And so I was saying to myself, how are these guys making money? I kept seeing higher trade prices and this, that,
Yeah.
and the other. I'll dial it back to the market. I'll be like, wow, this market and this sub-market saw a tremendous explosion. And even though the property is heavily neglected and tons of deferred maintenance, sorry for those who don't know what that is, and tons of even in some cases structural issues, people looked past it because of the market. So that's something we really take to heart. That's something we've been experiencing and always have experienced, that it's critically important. And then of course the secret sauce is having both, right? The best success story is having the perfect execution, or the best execution, whatever you want to call it, as well as an incredible growth market that truly ends up performing the way you expected it to. So that's always what we're striving for. That being said, it's not realistic to say you're always going to get both. And because we know that we can't always achieve both, we at least we aim for getting the market piece, because that drives the deal, and not vice.
Yeah, absolutely. That's a really great way of putting it. And you mentioned being an economics nerd. So what do you think about the economy right now?
Loaded question, eh?
It is.
Uh, I think the economy, I mean, let's start with, the facts, right? The fact is that we're in an economy that's hyper volatile. It's not only volatile, it's the uncertainty tied to the volatility, right? So, the lack of foresight, especially with more sophisticated investors, tends to scare them. That being said, we see that as opportunistic. We like lack of foresight, so long as you're at the right basis, right? If you're at the right basis, your NOI can fluctuate, you know, you can have a fluctuating NOI realistically, but if you're at the right basis, in 3, 5 years or 7 years or whatever, how long it is till you exit the deal, it doesn't really matter that you experienced a few years of a fluctuating NOI, right? So that's kind of our approach is like, sure, we don't want to have hindrance and volatility in our cash flow distributions to investors or cash flow to the property, granted, because that precludes that's a prerequisite to distributions. But, we're ultimately really looking at it from the lens of, hey, you have to make sure that the overall basis is good enough, in our case low enough, that even if it takes 3 or 5 years for the property to achieve where we believe it can in terms of rents and expenses, in terms of income and expenses, then we're okay with it ultimately, as long as we're buying it cheap enough per door. Obviously per door is more of a multifamily reference than it is anything else, but BTR reference than it is anything else. But that being said, it's something that we really delve into heavily, and I wouldn't say I would say we're basis first and return second. That being said, you can't just rely on basis, because there are deals that we're seeing now that the reason why it's trading at that low basis is merited on the fact that it's a very high risk scenario to ever get to those rental rate levels, right? So that's also part of the mix, is like, you have to make sure there's not a merited rationale to why it's not been able to trade at a higher per door per unit pricing.
Yeah. Well, the complexity of these deals makes me grateful that's not the business I'm in right this second, because I don't know if I can manage that level of risk with all those different variables. It's definitely not a business for the risk adverse, I would say.
Yeah, no, absolutely. And I also think, well said. I mean, I think it's not only, incredibly complicated, but it's also, I would say, it's incredibly it's hyper evolving. Like, it's a like we're almost in like, it's almost reinventing itself. I wouldn't say daily. I mean, at some points I would say daily if you asked me 2 weeks ago, but I would say probably weekly at this point. But the one thing that we have to always remember is, like, multifamily fund, you have to go back to the fundamentals. And if there's strong fundamentals and a positive outlook overall, yes, the turbulence is scary. Yes, you're going to hold onto your seats if you're on an airplane, and the second it stops, you have a sense of relief, and you'll want to go on another flight tomorrow, and you will be thinking about not wanting to travel, right? Same thing in business. People are emotionals, and they have experiences, and they make decisions based on their experiences, right? So we go back to the fundamentals. We find multi is incredibly strong. It's still the preferred asset class of CRE investors in 25 due to the continued solid fundamentals. I predict, along with a lot of, I'm predicting predominantly because it's a function of majority consensus of economists, that there's a positive outlook for multi through 25, even though there's been this hyper oversupply narrative. I think after a period of rising inflation and interest rates, that the multifamily will start to return a corner again. Again, I don't know when. I'll never try to predict that. I'll never do so, because I always find that's where most people get stuck, or get buried rather. And also, I think that the ample demand. What's been fascinating is there's still been demand, especially in Florida. In-migration has stayed strong. I thought it was, going to teeter back tremendously over the last few years. Like, hey, we saw an explosion in, COVID, or, right immediately as COVID hit or post-COVID, everyone was moving down to the Smile States, especially Florida. That really hasn't dropped much. I mean, sure, it dropped since, the peak of, the COVID in-migration narrative. But has it teetered back enough that the oversupply has not been absorbed? No, the oversupply is been absorbed, especially in Orlando. It's a great case study for anyone who loves econ, is that look at Orlando. The absorption's been like 95+%.
Yeah.
And that's been, what was it, top 3 for a number of years as the most oversupplied market.
Yeah.
Right. So that's something you have to kind of always think about, is where's that demand vis-a-vis supply, which is a classic, one-on-one econ perspective. And then I would say the tailwind of a declining interest rate is expected to usually support some sort of market rebound over the next, several quarters. So, we're still seeing that to be the case, and until we start seeing, I would say the jobs in the markets that we're in, the main employers in the markets that we're in, start to have some challenges, which we aren't seeing. We have no reason for pause, personally. We're still seeing strong renter demand, strong employment in the markets we're in, and also a lot of the reason why we when we underwrite markets, one of the main things we look at, is how diversified are the employers within the market,
Yeah.
and are they hiring, or are they stable? And look at the companies that are biggest and underwrite them. So we're not just underwriting deals, we're underwriting the markets, we're underwriting the key drivers within the markets. And then on top of all of that, which is incredibly important to understand, is demographic shifts. You usually want to have, good education, so high scoring education, schools, and then you want to have really you want to have this kind of like high cost of buying barrier experience in the market. So if it's, you want to have your cost of purchasing a home ratio to the cost of your buying of that unit, of renting that unit, to be favorable to define it a good renter's market, right?
Yeah.
So that's something we look at as well, is, hey, where is the key demographic vis-a-vis the cost of a home, or a condo, and then where's that, where's the rental rate vis-a-vis, of course, where they're able to, or where their median household income is. So we look at it from a dynamic perspective, and I think it's just incredible to see that. Even though we're not forecasting annual rent growth, we are seeing in most of our markets anywhere from 1% to 2.5%. So that's good.
Yeah, that's fantastic. And thank you for sharing all of those different ways that you can look at, analyzing the market and the asset, and helping mitigate that risk. Now, Marc, and I know that this question is coming, but I feel like this is going to be an interesting one, since your group doesn't today actually, manage the property management side of the house. And that's not an industry that you specifically have ever been in. So I'm interested to hear, but I'd love to hear a story from you about your time in the multifamily industry.
Yeah, absolutely. So I don't know. Yeah, to your point, I don't have any like really juicy, I have juicy management stories of crazy things that have happened at our properties, and staff at our properties and things of that nature. But they're not my story. They're right. They're my story, because I was either a beneficiary or not a beneficiary of that, and I was involved with the process, but that wasn't a direct experience I had per se.
Yeah.
That being said, we did find an issue whereby we had a property manager that was very close with a certain vendor, and they were constantly, it took a few times for us to see the pattern, but they had a real personal relationship, and they put that personal relationship before the professional relationship, and it became fairly noticeable pretty quickly. Unfortunately, our operator did not catch it, but we did, and we right away said, guys, we gotta, she's gone. Yeah, let's go. Let's get rid of, let's get rid of the situation immediately, because obviously they're being clouded and there's issues here, so they got to go. And we found out, unfortunately, soon after, that it wasn't just with that specific vendor, it was happening elsewhere. So exactly what we spoke about earlier.
Yeah.
Do I think they all knew that they were, playing around, I don't know, but bottom line is, like you said earlier, when there's one issue, there's tend to be a host of other ones to follow, and that's exactly what happened. So that was definitely something we experienced. That was pretty wild and something you don't really think about on a regular basis. And then one on the investment asset management side that we experienced, story that I think we could all learn from. I'm trying to make sure it's one that's good lesson learned. I think the story of transitioning, right? So we're in this market where basically we found ourselves in a position at a specific property where there's a tremendous amount of CapEx needs, right? And soon enough, we found that not only Hurricane Ian, but multiple hurricanes to follow pummeled through the property, and it took a massive hit. And it's still suffering from those hits, even though we're repairing it and addressing those needs. It's still suffering a lot from those from those events, those hurricane events. And so we quickly started to think about, okay, well, what do we do here? What do we do? Obviously, you start thinking about insurance and those things of that nature is your natural tendency. But what can we do, after being hit by these storms and, having a, how should I say, having a team that's looking out for, their own interests, right? And we're not obviously vertically integrated. So, this is trying to put the direction of the operator, the management company, to make sure that the team stays, even though that the team just inherited overnight a much bigger job, much substantial job with a lot more responsibilities, and job functionalities, right? So that was a very, 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 very big challenge. Of course, in this case, because I'm bringing it up, we did everything in our power to keep them, at the property, the on-site staff there, but we couldn't do it. We just couldn't do it, especially as ownership getting in the way of the management company. We felt that we were stepping on their toes too much, and then it wasn't really going anywhere anyways. So it was a big challenge. We quickly learned that, we had to make the decision to find the right employees. Unfortunately, we kind of went back to the same mistake. And when I say we, I'm talking about us and our operator, collectively, because we're at the end of the day, that's who drives the results. We collectively, found ourselves, not putting in, the right person who has experience with turning this type of issue around. Specific experience, because it's very, very specific when you deal with these damage. It's very nuanced, and it's also very, if you don't tackle it, you'll end up doing the same repair 15 times over, and the losses are tremendous. So, instead of finding that niche expert in this space and finding the whole team around them that have the same experiences, we only found one. But then what we found is that one person didn't have the time and ability and resources to teach the others. And so we had to then bring in a new team. And it was, candidly a nightmare. It just kept going on and on and on. It kind of felt like, we weren't able to get through this issue. And then ultimately we got lucky, honestly, due to the tireless efforts of the team, not lucky, but we were very fortunate to then learn that we have a prop PM and property manager, an assistant property manager, and a maintenance team that have all worked together on prior similar situations at another project. And then we're finally like, okay, let's give this one a shot. And then we started seeing better results. But it is a good reminder of, if you're seeing an issue, not only finding the people more capable and competent to solve that issue, finding the team that does it with them, A, B, invest more heavily. If you have a bigger problem, that means you have to invest more. And then it's counterintuitive, because you think, hey, I have so much more money I'm about to have to spend, so let me just spend the same amount or less on the talent that I'm about to hire, but to offset all that extra spend, that's a big mistake in real estate, a very big mistake.
Yeah.
And you should go above and beyond to the point to spend substantially more on that team, even if it's not, supported by other comp elsewhere, because they can save you a tremendous amount of money, in the process. And that's something that, it was painful, but we learned that lesson, those two very important lessons. And we also learned the lesson of jump on it right away. And even if your partner, in this case, they said, hey guys, they threw up their hands like, hey, I think it's best you find someone else to operate it. We did. And, now we're finally in the right direction. But again, it's really important and that goes to the big A word you mentioned earlier, accountability, that, we have to hold ourselves accountable to make sure that they're actually doing their job.
Yeah.
And if they're not, we have to then transition over. And so that's what we had to do. It's not fun. You don't want to be disrupting properties and partnerships and operators. That's not good form of practice or business practice. But it's sometimes a necessity more than it is anything else.
Yeah. Yeah. Oh, that's such a good story. And words of advice. I couldn't agree more. It's so important to spend that money on the front end, on the people, the fiduciaries who are going to be essentially spending that money for you. The more you pay them, the better that spend will be. So I couldn't agree more. Well, Marc, my last question that I ask everybody is, do you have a book that you'd like to recommend to our audience?
Yeah, so I personally have been loving Steven Schwartzman's book, What It Takes. I thought that's a fantastic book. Really one of the better books of talking about not only his own personal history, but sometimes the risks you have to take in order to see the reward.
Yeah.
I would say in addition to that, probably I want to make it something I read more recently, but Sean Cook is a great book, Investing in Real Estate Private Equity. I read that recently. That's fantastic. It talks about partnerships, funds, joint venture, JV, crowdfunding. So it kind of covers a whole host of kind of different ways of understanding investing in real estate. I thought that was really impressive. The way he really told the story, not only from a personal lens, but in more of an educational manner. So that was really, really interesting. And then I would say if I had to throw a third one in the mix, is I'm between The Liar's Ball and The Real Estate Game, but both of them are all. And obviously it's not so recent, but Sam Zell's I'm Being Too Subtle. I love that book. Because he just passed not too long ago. And so, I've been kind of going back over the legends of the industry that are no longer around and reading their books as like a personal thing I've been doing. And I'm Not Being Too Subtle, I think that's a must read. It's not recent. It's more like almost a year ago now, but I think it was published in 2017. So good timing on his part to see that while he was still around. But really just understanding his autobiography and the insights he has as a contrarian to investing, especially in my business, multifamily. It was kind of across the spectrum, but equity residential and the legacy he left. So I would definitely recommend that to the readers.
I appreciate that. 4 or 5 books that you recommended? 5, I think. Anyway, that's fantastic because this is the first time anyone has recommended that book, and I have not read any of them. So great, unique recommendations, especially for those who are really interested in getting into the real estate space or private equity investing space as well. So, well, Marc, this was a fantastic conversation. I really appreciate you taking the time to be here with me today. And just thank you for sharing all of your insights and your experience with our listeners.
Absolutely. And sentiments are mutual. Really appreciate the opportunity to be on, and I'm looking forward to staying in touch, and appreciate again the fact that we're able to carve out this time, and hopefully the same way we learn these lessons, hopefully that some of these stories are interesting and the lessons are learned as well.
Yeah, well said.